Let's bring in David Zervos from Jefferies. He's the chief market strategist there. Always talk to him on a Fed day. For your reaction, David, and your takeaway.
Hi, Sarah. It's good to be back on Fed Day, and I think it's, I don't think there was a lot that we learned that was new. The market is reacting, but for a Fed Day, it is volatile, but it's not that volatile. We've seen some pretty big days on Fed days this year. I think his message was the Jackson Hole message, maybe a little bit more negative, a little bit more using that word pain and trying to get people ready for this idea that there is short-term pain that we're going to have to go through. And it's all for the greater good of maintaining the anchoring of long-run inflation expectations, which I think all economists, policymakers, and I think, folks in the investment community see as a key ingredient to long-run growth. And the equity market is really trading that off now. It's trading off the idea that the anchor is in place. The anchor is well taken care of. We're going to be all right in the end. And that's what the Fed is telling us, and that's what they're here to do. But to get there is a very difficult and treacherous hike up the hill, and probably fraught with a few slips and falls everywhere.
So the question is, what do you do with bonds, and what will that determine about stocks? Because a lot of what you just said is already priced in. I think that's part of the indecision, is the positioning here, right? We knew that the Fed chair wants pain. We knew that they're just going to keep hiking rates until they see more compelling evidence inflation is coming down and unemployment is rising. So with the 10-year now at 3.5, it's been a big move. The 2-year at 4.1. What do you do? Is that the peak, or you think there's room to go higher there on those rates?
I think they could certainly go higher, and he told you it's all about the fight, and we don't know. The answer is, Sarah, nobody knows where this peaks out. Nobody knows how long the supply disruptions last, how long the negative supply shocks are. What we do know, and I think Jay's been very adamant about telling you this, is that they're going to fight it. So I think June was a very interesting time. We were lower than this, and we were talking on that day, and the Fed did 75, and they sounded very tough. And the market kind of liked it. The market liked the idea that the anchoring was going to be taken care of, because that's great news for equities over the long run, and equities are a very long duration asset. And I think we felt pretty good about that. We didn't know how much short-term pain we have to take. And now what we're doing, and that's, I think, why we rallied up for 3 months. And now we have to kind of contend with this other force that's driving equities lower, which is higher and higher risk-free real rates that are going to push us negative for a time so that we can get that anchoring in place and get inflation back to 2. And so it's a tussle. It's a tussle between the good news at the end of the rainbow and the path by which we get to the end of the rainbow. And again, it's very unclear. And I think Jay was pretty good about telling you that. You hope for the best, prepare for the worst. It's not the greatest line, but at the end of the day, we know they're going to take care of the anchor, and equity should like that. And that should keep a bottom that's not too severe in place, and the market should like it. In the meantime, we just don't know how high real rates have to go, and they may have to go a lot higher, and that's going to hurt. It's going to hurt. But I think the fear, David, is that he overdoes it, is that they overdo it in their zealousness to fight inflation. And we know that it hits with a lag, and we're already starting to see some of the damage in the housing market, consumer, jobs. I mean, it's starting to show up. And we know that the Fed has made a lot of those mistakes in the past. And really what he's telling you, Sarah, is that if they're going to make a mistake, it's not going to be a mistake of declaring victory too early. So you almost know they're going to go too far. And I think the market has to price that in. And look, maybe down at 3650 on the S&P or a little bit lower or back to the lows, the market's kind of priced for a mistake. The market's priced for that overzealous, higher real rate that really knocks things down. And then the Fed kind of does what it did in 2019, which is reverse a mistake. And I think it's a tricky time for valuation. But if I have to think about it, between 3,600 and 4,200, I kind of think a soft landing is pretty much in price. Below those old lows, we start to price in a mistake and a harder landing. And then we have to think about how quickly the Fed pivots from that. And above 4,200, I think Jay told you at Jackson Hole, you guys are pricing in no landing, and I'm going to, smack you over the head, which he did.
Which is what they did, and they just did it again. So let's talk about the dollar, because there was a question there about international coordination, cooperation. He said we don't coordinate on policy, but we certainly talk about it, and we share a lot of information, which we know. So now that the forecast from the Fed itself is to go another 125 this year and potentially more next year, and the dollar is already sitting at more than 20-year highs, how are they going to deal with that situation? Isn't that going to be problematic?
I actually think they want a stronger dollar. It's a very unique time with oil prices high and the dollar strong. And I think the administration and the Fed are quite happy with a strong dollar. It suits them. The stronger we go, the lower energy prices come, the faster energy prices come down, the less money we send over to Vladimir Putin, and the faster the Fed solves the inflation problem. So it's a very unique time in dollar policy history. I know something you've studied a lot over your career, Sarah, that we have such a strong dollar. And actually, I think both folks who set dollar policy, the Fed and the Treasury, are quite content to see it go, which is not good news for our trading partners necessarily,
right?
Who
Everybody
have
else
to pay
is not
back
content.
pretty strong dollars that they borrowed. Yeah.
Right. I mean, emerging markets and this dollar-denominated debt, euro, not going to be happy if the euro, it's good for their exports, but not if their currency is crumbling. Thank you very much, David Zervos. We've got to leave it there. We appreciate it. From Jefferies.